panelists is Tapani Varjas, and Tapani is talking about from the financing sector. He's a partner at Juuri Partners, who is a financing and business development company investing in SMEs. He will tell a little bit more about the company. Tapani is working with small and medium-sized enterprises. He has extensive experience of more than 20 years in entrepreneurship, investment banking, mergers and acquisitions, minority ownerships, corporate governance, and risk management. And he is responsible for the development of corporate governance, market mergers and acquisitions, and financing documentation, risk management, and shareholder value creation through management of corporate responsibility in the investment activities in the investment company. And it might be of interest to you to know that Juuri Partners has recently signed the Principles for Responsible Investment, PRI, supported by the United Nations. So this is something that most probably is coming into the investment companies as well, and we'll be very keen to hear more about how Juuri Partners is looking at the questions. So Tapani, please, the floor is yours.
Thank you. And now the most exciting moment, whether I get the presentation. Okay. First of all, these slides are taken from our sort of annual ESG report. These are rather busy. I'm not going through every single word in the presentation, but to try to walk you through the main message of each page. But thank you, Kim, for presentation. Juuri Partners is a private equity company which, as Kim said, invests in SME companies in Finland. We are currently managing 2 funds with assets under management slightly more than 200 million euros. We have 3 handfuls of large pension and insurance institutions in Finland as our investors, and also in the second fund we have also investors outside Finland. We are a small team of 12 people. So if Nitor was a small company, we are even smaller. I don't know how well you know the private equity business, but to put it very short, we draft a sort of a investment strategy. We hire a group of people that we tell the investors that are excellent to execute that investment strategy, and then we go to a fundraising process where we try to raise a fund which we will invest in 3 to 5 years, typically about 10 to 10 companies. We create a shareholder or value creation plan for each of the investment. We develop the companies for 3 to 5 years, and then we try to exit the companies. And at the end, we hope to be able to deliver good returns to our investors, and then the circle starts again, and we start raising a new fund. So it's expected that we would be raising a new fund in 2 years or so, and in order to be sort of a interesting opportunity for our investors, ESG matters are something that we really need to take seriously and be able to respond to the requirements of investors that they have when choosing private equity funds or fund managers like us. So where the market is heading, I think this is a circle starting with the limited partners. That means that, i.e., our investors, they are feeling a pressure from the legislation, which Ari mentioned, briefly in the previous presentation, and they also are facing a lot of sort of a pressure from their stakeholders. Stakeholders of pension funds and insurance companies are really interested in having a sort of a positive impact in the society and in the environment, social governance issues, and they put a pressure to us general partners, the fund managers, that we need to comply with the sort of ESG standards that are placed by the investors, and when choosing fund managers, when engaging with the fund managers, they put more and more pressure on how do you select the investment companies. Do you see ESG related to risks or opportunities in these companies? How do you integrate the ESG matters to your investment processes, and how do you report ESG related issues to your investors? So this puts a lot of pressure to us to put pressure to our portfolio companies like Nitor, as Ari mentioned, and we try to in Nitor's case, it was very easy. They have started the ESG journey a long time ago, and they are very well advanced in their ESG thinking and approach. But many of our sort of a small companies are starting their sort of ESG process with us. When we make the investment, we raise the ESG matters, and we take them into our sort of a value creation plan, and then we follow those matters with our portfolio companies throughout our holding period. So this is a kind of a reason why we are so interested in ESG matters. We want to be compatible with our sort of investors' expectations in these matters. And this is a kind of some data. If you look at the figures, especially the sort of a larger investors, 2/3 or more of the investors with the assets under management of more than 5 billion are increasing their allocation to ESG funds, and this is something that we need to note in order to be able to be interesting opportunity for our investors. And the bigger the fund is, the more sort of allocation they are thinking of increasing in the coming years. So the data is very clear. Ari also mentioned about the sort of regulation, and in our sort of a financial market, the regulation it came into force a year ago or so, a year and a half ago, and it's very clear that the regulator is interested in finding out how we are taking into account the climate change matters, sort of social matters, governance matters in our investment operations. And the SFDR, Sustainable Finance Disclosure Regulation, is the most relevant and applicable law to our operations. And that regulation has a sort of a classification of investment products. You have a sort of Article 6 products, which are funds that are not taking into ESG matter, which are not taking ESG matters into consideration. Then we have a sort of Article 8, which where the matters are integrated in the investment processes and followed with the sort of a relevant KPIs and are compatible with the sort of SFDR regulation. And then we have Article 9, which is sort of a dark green, which is kind of a impact funds, where the investments are made in the companies which aim to change environmental issues or governance issues or social issues. The purpose of the company is to have an impact on these matters. And if you want to raise a fund in EU in the coming years, it's very unlikely that if you are Article 6 fund, it's very unlikely that you are able to raise a fund. I know from our investor base that I think we wouldn't have any of the current investors if we chose to be a sort of Article 6 fund in the coming years, or our next fund. So the sort of a minimum is Article 8, where you need to incorporate these matters into your sort of investment operations. So it's very clear that if you want to operate in private equity environment in Europe, you need to have a ESG strategy, ESG policies, and you need to integrate ESG matters into your investment operations. So the decision is very easy that these are issues that you need to start developing now if you haven't done it beforehand. We did have a little sort of a questionnaire to our investors and some experts that what are their expectations of Juuri's ESG work in the future, and I think the message was pretty clear that some of our investors said that it's a bit of a problem if we are not United Nations PRI signatories. It was maybe one or two of those investors, but clearly it was something that the investors would put a lot of value in. It's a hygiene matter these days. You don't get sort of any extra points for being taking into account ESG matters. You are excluded if you don't have that approach to your investment operations. The sort of a thinking is that the whole team needs to be involved in the ESG process, and you need to follow the progress that you are able to make with your sort of a portfolio companies. Set clear KPIs, follow them, and report them to the investor base. So, how did we had a sort of a about a year ago, we did these interviews and had a kind of a workshop. How would we develop our ESG approach, and this is sort of the outcome of that workshop. Maybe taking a step back, ESG has been a part of our investment strategy all the time. This is the sort of the quote up there is from our first fund documentation, and I think we strongly believe in creating long-term shareholder value by linking the sort of corporate responsibility themes with the strategic goals of our portfolio companies. We added sort of the reporting part to the new approach. We will implement a systematic KPI-based approach to monitor the progress of our portfolio companies, and we will have a sort of annual reporting to our investors of those KPIs. But I think the basic idea is still there, that we don't see that taking into account ESG matters, ESG value drivers, and the risks related to ESG matters. I think we create value and manage risk better. It's one angle to the investment strategy that we have, and it's an important angle of that strategy. So that's basically the reason why we decided to sign PRI. We were ready internally for signing PRI. Previously, I was responsible for ESG matters alone, and now we have a team of 3. We have the reporting capabilities much better than previously, and it was a sort of a right time for us to sign the PRI. Then we sort of had a more systematic approach to the portfolio company engagement. As Ari mentioned, we had a workshop with Nittor, and we chose the KPIs and SDGs with them and the reporting sort of standards. And then we increase our investor communication, and we will have a sort of more structured way to communicate the progress made to our investors. Our approach, we systemized our sort of ESG risk mitigation and value creation sort of approach. We have a ESG team of 3. We will follow the regulations and sort of educate our deal teams regarding the latest developments. And we will be throughout the sort of a holding period and acquisition period, we will be supporting our deal teams with the sort of a ESG value creation matters. Deal teams are responsible for sort of choosing interesting companies to invest in, conduct the ESG DD once the acquisition phase starts, and create ESG related value driver plan. And then we chose the sort of KPIs which will be followed by a deal team prepared by the portfolio companies. We will monitor the progress, and once we approach the exit phase, we will be ready to tell the next investors that we have made clear progress on ESG matters. Risks related to ESG matters are minimal, and there are positive effects of the measures that we have taken during our holding period. And this is basically explaining the approach to how to select the value drivers, the KPIs, and reporting. And this looks very much like the pages that Ari showed a short while ago. So this is kind of the reporting or sort of the changes that we made during the sort of the latest development of our ESG approach. But what is most interesting from my angle and most exciting in this ESG works is to find the actual value drivers in portfolio companies or potential portfolio companies. And I quickly want to show you a sort of a one case. We invested in Camrock, which is a rock crushing business. When we invested in this company, all my friends in the street said that, why on earth did you invest in rock crushing company? Because it's a low profitability, a lot of capital expenditure, not very exciting. Why did you do that? This is a company that is a spin-off from a larger sort of a industrial company, which had a manufactured sand sort of a program which they scrapped. They were not interested in that making manufactured sand from rock. 2 guys from the company wanted to take that project with them and start their own company, which they did. And they started from zero, and in 5 years they have a company with a turnover about 40 million euros and making a profit of some 20% or so. So it's very profitable, very fast growing. The most profitable part of that business is making manufactured sand. And that has very positive ESG effects because it's used in creating concrete. And when making concrete, cement is the most CO2 intensive component of that production process. And with the high quality manufactured sand, it is possible to decrease the amount of cement required by 15%. So in the process of making cement, we can make some significant savings on CO2 emissions. And the other angle there is that the sand is running out in the world. So in Finland, if you want to use natural sand and build something in the Helsinki area, you need to get the sand more than 100 kilometers away from Helsinki, because it's run out in the capital region. So to be able to produce sand on site or in close to the site, you can save significant amount of CO2 emissions, as you don't need to transport that sand to the site itself. So we actually calculated what are the savings in practice and what are the effects to sort of biodiversity also, in addition to CO2 emission reductions. As a result, we are able to communicate these, and as mentioned, the most profitable part of the business is the manufactured sand. We get a lot of interest from companies in this field, because this is the only company in Finland which is able to make manufactured sand from the rock that we have in our grounds. So there is a clear value driver in this business related to ESG approach in preparing manufactured sand. So this is, for me as an investor responsible for ESG matters, this is exciting stuff. Thank you. This was my sort of a presentation.
Thank you, Tapani. Very interesting to hear the investor voice. We have a couple of questions here, but I would first want to ask actually you and Ari about the legislation you both have mentioned. Now we know that the legislation is focused on large companies, but you are both representative SMEs, where the legislation doesn't hit directly. But if I heard you both right, it hits you indirectly. Is that the case? And is it so that in fact it's your stakeholders that require you to do these ESG sustainability topics in order for you to be in business?
I think if Ari start, I think the legislation regulation hits us directly. We need to be compliant in order to be able to raise more funds and continue our investment operations. And maybe Ari is in a position where our sort of a pressure to our portfolio companies affects indirectly the requirements that we need to have in order to be able to invest in companies like Nitor in the future. But of course, there is a sort of also the direct effect in Nitor's business, whether their customers are requiring ESG matters to be taken into account. But from our perspective, the legislation that affects us won't affect directly to our portfolio companies, but through our sort of our involvement, it's also coming to SMEs, and this is something that is good to understand if you are advising these companies in other fields of business.
I catch you, Tapani, right. In fact, making your investment companies creating the ESG sustainability reporting and the way of working in the companies is a value creator for you when you exit the companies.
That's what we try to find, those value creation levers which enables us to both limit the risks but also improve the business itself, as it does in Camrock's case.